Hello, hello, hello. Welcome now, Stock Trades. What's going on, my silly mother? It's been a while since I've said that, huh? So my apologies. I look very tired. I have been popping questions for it's a neurology NBME exam, National Board of Medical Examiners. It's a very tough exam, but I have been popping questions like crazy, and I wanted to take a quick break to talk to you guys and share with you what we've discussed on our private stock group. I think this is definitely something you guys need to hear about and need to just kind of conceptualize. Okay. So, this is going to be related to Clover Health. It's going to be related to stocks that have some potential, that have some gas in them, right? I'm not talking about stocks like are very speculative in nature that don't have a strategic plan to essentially have a business model. So, uh, without further ado, I want us to basically focus in on the equity hedging index. Okay, so as you can see here, this is the S&P 500. Okay, and every time you can look at it, every time we pass the green line, it has been historically a great time to buy. Okay, so there was one in 2008. There was one in 2011ish to 12ish here. Okay. There was one in 2015 to 2016 here. And then 2018, and then 2020. And then here's another one here. So overall, there really isn't that many times. I would say 1, 2, 3, 4. We'll conglomerate this to 4, 5, 6, 7. There has been in the amount of, let's see, 14 years, there have been 1, 2, 3, 4, 5, 6, right? 1, 2, 3, 4, 5, 6. We're conglomerating this. 6 out of the 14 years, we've essentially had this equity hedging index get to a point where it has been a great time to buy. Just imagine if we would have just looked at this and I would have been able to make videos at the time to share this knowledge. I would have, a lot of people would have been helped. But I was, unfortunately, I was really busy during that time. But it's unfortunate. I kind of wish I was here for all of this with you guys. I mean, not so much here. I was honestly learning about the market back here, so I would probably be no help for you here. But overall, I think it is what it is. But now we're here, and I'm here, and I'm here to help. And as you can see here, this is a wonderful opportunity. Okay. So, what are we looking at in this picture? This is called Corporate Insider Sells. XLK is a technology ETF, and it basically looks at the insiders in the company, whether they're buying or they're selling all of the tech stocks within that. Okay. And the green is obviously when the sells are at their lowest. And then obviously in the red here are when the sells are at their highest. So the pandemic was a fluke. It was honestly the only time retail investors did something right. They bought and they did good. Rest, everybody sold. And the retail investors were like, no, let's go to the moon, baby. Let's go, whoa, let's go rip, right? Well, a lot of selling happened here because many insiders were scared that this pandemic is going to shut down the whole world. I mean, just remember back when people were dying left and right. However, all of a sudden, the stock price literally went to the moon. Okay. And more insiders started to sell. Okay. Now stocks have been falling. And now corporate insider sells for technology stocks are at their lowest they have been since 2012. Look at that, 2012. So I have a couple of folks that follow me on Twitter. One of them is LPL Finance, which is a pretty well-known investment strategy platform that hires people that are older than myself to look at the market. And I'm, by the way, I'm humbled and honored to essentially have a community where I'm able to like do my life purpose, which is to help people. I mean, it's amazing. But I mentioned them strategically because they specifically stated that they are looking at a market that's similar to 2012. Well, ladies and gentlemen, it's just, if you look at here, what is this? This is 2012. And the last time we had corporate insider sells this low was 2012. Okay. So what happened in 2012 and what was going on? Well, in 2012, we were anticipating that the Federal Reserve was about to taper, and they did. They did. It was in 2014, 2015. In fact, we had a taper tantrum, okay? And that's why we had this huge decrease in the market. And if you look, for all my mastering stock market students, if you remember, we have a analyzer tool that helps you look at the market's FOMC, Federal Reserve interest rates, on how that essentially works. And it's an interactive tool here. If I can, let's see, take a look at it here. It's a Federal Reserve variable shifter. And let me go ahead and share with you how it looks like. Pardon me. Let me go here. There. Okay. So if you go to Federal Reserve variable shifter, and if you scroll down here, you can see the evolving cycle, and you just keep scrolling, and it shows you when you can read this and you can see exactly what the Federal Reserve was doing. They were tightening, and all of a sudden you can look at the Treasury yield curve, and you can look at that, and then analyze this component. Then you can look at previous tightening schedules over here. You remember when Federal Chairman Bernanke was in control. Then you can look at easing. You remember when we basically did some easing here, right? So, and then this was a period of zero interest rates where we have it here. And then we had some form of a taper, a tantrum, I remember, during 2014. So, we use these models to help us essentially get an understanding of how this all connects, because economics is just not only the study of goods and supply and demand curves and using calculus to find strategic important elements within the market. No, it's also the analysis of the psychology of the people within inside this GDP fueling index, right? And what's interesting is that we are approaching a time in history where we have been in a very overvalued market for quite some time. And now we're approaching a market that is approaching its historic mean reversion, which doesn't really happen too often, especially with a growing economy like the United States. So the point here is the last time you had an opportunity like this was back in 2012. Okay. 10 years ago. 10 years ago. And on average, the life expectancy, if you're lucky, is around 80 years, okay? And by the time you understand the market, I'm going to be very generous here, is 20 years old, let's say, which you most likely not. And if you are 20 and you're part of our group, my hat's off to you, okay? But on average, let's call it 20, okay? Most people get in the market at 30s and 40s and 50s and 60s. It is what it is. But how many 10 years do you have from the ages of 20 until your life expectancy at 80? Well, let's say you want to retire at 70. Okay, let's push it up 5 years to make the numbers even. 70 minus 20 is 50. So you have you have 5 times in your life that you could get something like this. Okay, 5 times. If you start at 20, if you're at 30, you have 4. If you're at 40, you get the point. Okay. But what's interesting here? It's not even granted that this will happen every 10 years. Sometimes it might take 20 years. You understand my point? And the data is clean. You look at the data. I'm not making this data up. This is corporate insider sells. And if you follow other very smart investment strategists, you will see there's a common link of what I'm saying because we derive our data from the same input, which is the behavior of the market. Okay. So that's what I wanted to communicate with you guys right now. It's something that we talked about. And for the people in my group, this is more of a completed, well thought out statement. I wanted to basically point. Thank you so much, Petro. Thank you. Pedro, right? My apologies. Let me know if I said it right. And then I am lucky to get into this at 21. You see, imagine. You see that? It really is luck. But you know what's crazy? And, we can't beat the GOAT himself. But Warren Buffett stepped into the market when he was 13 years old. I mean, you know what I mean? It's pretty crazy, right? I would say conservative would be 30. Yeah. I'm just saying 20 because I hope there's 20-year-olds that are watching this because, compound interest is the sixth wonders of the world, according to Albert Einstein. And the more time you have, the more it can compound. And it's important to teach your kids this too, because if you leave it to the educational system, they will fail you. So in 2012, corporate selling was almost this high. No. So in 2012, corporate selling was low, right? Corporate selling was low in 2012. Okay. It was low. And then your question is, how come the stock market wasn't going down like this now? So if you look at the stock market here, I mean, I can argue it was going down right there. Wait, let me show you the graph here. So if you look at to answer Mr. Scruff McCruff here, 2012 is when the corporate selling was at its lowest. Corporate selling is not at its high because they don't want to sell right now, right? Why would they sell? It's an indicator to tell you that they're holding, right? But I can argue, you can say that that looks like that looks like a little dip right there. I mean, it may not be a big of a dip because it was oscillatory, but we were experiencing we just came out of a great financial crisis. Another thing that we have here is we have a war in Ukraine by a nuclear powered country, and the other issue is we have a 40-year high inflation. So those are just kind of surface analysis, you can say. No, it's all good. Yeah, no, I'm happy you're here. But yeah, I just I wanted to kind of talk to you guys about this and just share with you my thoughts. And I've been kind of quiet recently because I've been really composed at the hospital. It's been very wild ride at the hospital. The clinical practice has been a little bit more than usual. And I'm not just saying that as a student. Other physicians are saying the same thing, and so that's impressive. So small dips may not look like dips because the stock price was small back then, but the percentage drop were still significant. Exactly. So if you were to go to stocks back then, they were still dropping 40-50%. You know what I mean? It just, because it looks small, you know what I mean? Yeah. How the heck are you, Habibi? I'm dying to know your take on Clove right now. Chamath dumped the truck on his holdings, but other players like Clinton are buying. No, very true. Very true. I believe Chamath sold because of tax loss harvesting. I don't think the Federal Reserve is going to pivot anytime soon. I think because core inflation rate has been increasing. In fact, I want to share with you guys somebody here. Let me share with you on our private Discord group. You could YouTube this feller. I really enjoy him. Where is he? Clear Value Tax. I really like this guy. He's very smart gentleman. I have his videos on auto. Again, I want to make everything one stop, so you can use our software. Then you can check. Oh, this guy made a video. So it's all in one place. So you kind of maximize your time and learning opportunity here. It's so yeah, I recommend looking in Clear Value Tax. He does a really great job at explaining the pivot. It's I think he definitely puts it into perspective that makes it easy for newer investors. But yes, so I think Chamath Palihapitiya is following in line with Clear Value Tax's ideologies regarding pivot not coming anytime soon, and him utilizing this movement to potentially do a tax loss harvesting. Okay. And I believe we are closer to a bottom than ever. I believe that the last stocks that are going to get destroyed, or everyone is waiting for them to get destroyed, would be Tesla, Microsoft, and Apple. We've already seen Facebook get hit, Adobe get hit. Now we see Netflix rebounding because of the customers. Oh yeah, we are live. We are live. You're not just watching a video. You see, we're live. I don't know why I did that, but yeah, we're live. Yes, yes. I was wishing it would go back down to 2, so and now it's below 1.5. So I'm grabbing. I mean, I don't know what else to do anymore. I mean, I am grabbing as much as I can. It is, this is why I tell you. This is why I tell you. Predictions. You can look at analysts' expectation, but as a long-term investor, you just basically react to what they give you. Predicting really is not going to give you much unless you're like day trading it, which you can in our software. One of our trading partners. You could use earning surprises, type in the ticker, and it'll tell you on average how much the stock moves in earnings, and you can use that to your day trading advantage. I'll put it up later regarding the command. Oh, hell yeah. No, yeah. Welcome to the family. I would have to take a look at it again, but I have done an intrinsic value. I would have to take a look at it. Speaking about requests, so I moved the date. On Sunday, we are going to be, for all of our Al Stock Alerts members and for all of our Mastering Stock Market students, we are going to be meeting on Sunday. On the questions tab of our private stock group, I've asked you guys what time do you want to meet, giving you guys the power to decide, because my humblest apologies, my clinical schedule has been pretty packed. But I want to give you guys the freedom to decide what time you want to meet and work it out amongst yourselves. And you can essentially tell me, what stocks you want to look at, like ATER. I believe one of the questions was, how do I find stocks and how do I know if they're good or not? So we're going to go ahead and take a look at that, and we're going to be implementing a stock screener. Okay. Again, very quick to talk about some things here. I'm trying to remember a couple of things on the agenda. Oh yeah, so for the Al Stock Alerts, it is $11.99 a month. I had somebody ask on the questions on one of the videos when I checked the YouTube app. It's under $12 a month. There's no hidden fees or anything like that. It's literally, you can cancel whenever you want. Again, it's for data. I don't take $1 of profit from it. It all goes back into what we're creating. If you were to calculate everything that we offer, you would see that it would cost you about $800 to $1,000, and then other stuff that you don't technically have access to directly, but I give it to you. So that's essentially what I want to say about that. But overall, I hope this was good. I'm going to repeat it again, and then we'll go ahead and end it. Once in a lifetime opportunity. The last time corporate sales were this low was back in 2012. That was 10 years ago. Guys, 10 years ago. This may not happen again for the next 10 years. Okay? So take advantage. This is a once in a lifetime opportunity. All right, guys. Love each and every one of you. And that's all. I'll see you on the next one.